Hi, it's Dre Griggs, of Obsidian Wisdom. Today was the question, what is the biggest risk to a successful retirement? So when it comes to a successful retirement, I kind of get this question afterwards, like, look, Dre, what is the number one thing that I need to do to make sure I retire successfully? And you guys already know that there's really three things that most people have to figure out when it comes to a successful retirement. But today we're going to expand that list and talk about this 10 risks to a successful retirement. The first one is longevity risk, which is a very fancy way of saying I might outlive my money. Well, you guys know to solve that, there's really a couple of solutions you have. Most people are going to say, well, I should look at an annuity. An annuity is going to be a hedge for your risk where you have this ability to have an income stream for the rest of your life. When it comes to an annuity, you might have even heard it referred to as a pension. They're interchangeable if you ask me. They really perform the same function. If you have a pension at your employer, they have that pension through an insurance company. They have actuaries who are going to estimate the age of everyone inside their retirement plan, and then they're going to be tasked with the job of making sure that pension stays funded, which is a very fancy way of saying making sure it doesn't run out of money. Now, one of the cool things about an annuity is let's say something changes where all of a sudden we go from living on average to 78 in the United States to where we go on average to living 108. Well, your annuity and your pension is going to pay you an income for the rest of your life. It's already baked into that cake. So the longer that you live, the more money you have the opportunity to receive from those type of income strategies. Now, the issue with an annuity is for the most part, most of them are designed where you don't get to actually take advantage of the growth of your investments. Now, what do I mean when I say that? What I'm basically saying is if you put $100,000 in, they're going to give you an income for the rest of your life. But the growth of that investment, so when the stock market was to grow at 10, 20, 30%, you don't get to take part in that growth. That is the trade-off where we're going to take away the investment risk. We're going to take away the market risk and we're going to take away the risk of you running out of money. But that means that because we took all that risk, we now get the access to all the extra money. So most annuities are generally going to say, hey, let's pay you maybe 1.5 to 3.5% on whatever you put in. That will be what the amount you receive. And I'll put another link to a video where I go into more detail about how to determine how much you will receive from an annuity. But basically, as long as they make more than that amount, then the insurance company wins. And you and I both know insurance companies are very wealthy firms. They are able to put the numbers together in a way where they make money hand over fist. It's not to say that they don't serve a purpose because they do, but it is to say that they design it in a way where they are going to win and they're going to win big, which means if you have the ability to put your own plan in place, then you can get rid of that middle person and you can have your own income that you don't have to worry about running out either. Number two is your healthcare costs. The risk of us running out of money in retirement due to healthcare expenses is kind of high. On average, it's estimated that we will spend about $315,000 over the lifetime of our retirement. That means that we need to have a plan in place to fund our healthcare expenses. Now, as we get older, for the most part, we wouldn't be surprised to understand that maybe we have to go to the doctor a little bit more often. The numbers say that on average, 7 out of 10 people 65 and older will have at least one long-term care episode. So that means they have to have some sort of plan in place to fund that. And depending on how active we are, whether we go walking, how healthy we are as far as what we're eating, and whether we have any family conditions, that could also be things that takes away our funding for our retirement. A lot of the times we have things like life insurance because we're worried about dying too early, but we don't always have an option as far as living too long where someone may get cancer. Well, that means we didn't die right away, but we're not able to really work and it's taking a lot of money to go to these different treatments to the doctors. Well, do we have a plan in place to fund that? If we end up with dementia or being disabled or really any sort of health issue that is over an extended period of time, we have to have some sort of money set aside to be able to fund these expenses. And as you know, healthcare expenses go up every year. On average, it goes up about 6%. It outpaces inflation. And I won't get on my soapbox and go into detail of why our healthcare system is the way it is and how we can fix it. But it's important that we just know that it's something that we need to take care of. And if we don't, we definitely run the risk of running out of money in retirement. So to help make sure that your retirement plan is a success, there's really two options that you can take advantage of. Obviously, there's more, but there's really two we're going to focus on today. Number one is whether you want to have long-term care insurance or whether you want to start funding a long-term care alternative. I have videos where I'll put a link so where you can go through that. You also want to look at your health savings account if you have access to that through your employer. Generally speaking, you need to have a high deductible plan to have access to that, but that is what we consider our triple tax benefit. You get to put the money into your health savings account, tax deductible, so that means you'll pay less taxes today because you put the money in. The money grows tax-free, so you're not going to pay taxes on the money as it grows. And then if you use it on healthcare expenses in your retirement, you get to take the money out without it being taxed, which is pretty nice as well. Which means that if you put a good amount of money in your health savings account, then you really have this tax-free money that you can access. And I'll put a link to another video where I go into a little bit more detail about a health savings account, but that is definitely a great strategy to make sure that your money is being used in the most efficient manner. So that way you're able to hedge against some of these risks that we know are likely to happen. And then we can ensure that we have a successful retirement. Number 3 on our list is inflation. Now, you guys know I don't have to go into much detail because inflation has been crazy over the past few years. A lot of it has to do with COVID, where there was supply chain issues and everybody was getting raises as we are getting new jobs and making more money. It's this idea that inflation is going to come around when you look at a chart, and I'll put one up for you. But when you look at a chart that shows the economic cycles, you'll see that we go through recessions and peaks and times of economic growth and economic decline. Well, every time you're starting to get to the peak of economic growth, that generally leads to inflation. Well, that cycle happens at least once every 10 years. So if it happens once every 10 years, that means that it's very likely that you will have multiple times where you're going to have to deal with inflation in your retirement plan. And so you have a few things that you can do to take advantage of this. Number 1 is we have TIPS, which is a Treasury Inflation Protected Security. It's just debt with the government that's tied to inflation. So as inflation goes up, you make more than your average bond. So it's a nice hedge for inflation. Number 2 is you invest in assets that perform well in high inflationary times. So generally speaking, real estate goes up with inflation. Generally speaking, people invest more in gold in times of inflation. And we normally invest in bonds in times of high inflation because the Fed raises interest rates because they're trying to combat inflation, which you just lived through, so you're already well aware of that. And now we're able to start getting returns of 3, 4, 5, even 6% on bonds because the interest rates are so much higher. And so these are normally investments that perform very well in inflationary times. And it will make sense for you to add this to your retirement portfolio just so that when it happens, you're not in a position where all of your money is decreasing, but you have assets performing very well through those cycles. Number 4 on our list is market risk. And all market risk is I'm saying I'm invested in the stock market and the stock market is going great. My investments are performing well. But the reality is there are different performing assets that perform well in different economic environments. Now, I won't go into too much detail because I don't want to bore you with it. But the idea is there's different assets that perform better in different economic environments. That we're in times of high economic growth, and it probably makes sense to invest in businesses. The businesses are going to be the ones that perform the best in those types of climate. If we're in a recession, then I probably shouldn't invest in cruise lines and luxuries because we already know people are going to cut those expenses back first when they're trying to figure out how to pay their bills. At the same time, it also means if I invest in things called consumer staples, staples means it's a part of our everyday life. Like we always need to buy toilet paper. We always need to buy food or water. We always need to buy toothpaste. There are certain things that it doesn't matter what the economic climate is, it's going to perform very well. Once you understand these, then you diversify and build a portfolio that performs well through a variety of economic climates. So that way you're generally speaking going to be making money throughout your retirement. The goal generally for most people is to make more than 4% because for most people, they're withdrawing somewhere around that 4%. So as long as I'm able to outpace that, then I feel really good about my overall not dipping into my principles and my investments. When you diversify, most people are going to diversify between the stock market, bonds, and other asset classes. Depending on how sophisticated of an investor you are, you can really go into some of these alternative energy. You can go into international markets. You can go into emerging markets where it's a whole world out there. We don't only have to invest in U.S. companies, but for most people, because we just don't have the time or the interest or the desire to be looking at all of the world markets before we make any investment decisions, we focus on the U.S. market. And you can make plenty of money just focusing on the U.S. market. Warren Buffett and other great investors have done it for a very long time. But it's just simply to remind you that you would diversify based off of your overall concerns, and then you would have an opportunity to have a portfolio that is performing well in every economic climate. But at the same time, that means a portion of your portfolio will be performing poorly through every economic climate. But that's the idea of diversifying. Now, there are some people that would say, well, Dre, wouldn't I make more money if I just chose one stock that I was really confident in? And the answer is, of course. If you actually know what you're doing, if you actually spend a lot of time in a company, sure, you can make more than a diversified portfolio. And you have to look no further really than our congressmen and women because they have insider trading information because they're in the oversight committees and they make a ton of money investing. So we already know that, yes, if you actually have all of the information, then for sure, you're going to be able to crush it in the stock market. The reality is most of us don't have all of the information. And because we don't have it, we then want to hedge against the risk of the unknown. Number five is interest rate risk. And all interest rate risk is basically what we're going through right now. It's the idea that I bought bonds at a 2% yield, and now all of a sudden we're at higher interest rate and you can get a bond at a 5% yield. Because I can buy a bond today at 5%, that means no one's really interested in buying my 2% bond. And if I was able to sell it, I'd probably have to offer a significant discount because it's just not worth as much as a bond they could buy today. And so to overcome interest rate risk, we normally invest in what's called a bond ladder. And all it is instead of us just having all of our bonds expiring at the exact same time, which is like, hey, I'm going to retire for 20 years, I have a 20-year bond. Instead, we have a ladder. So I have some that expire in 1 year, 5 years, 10 years, 15 years, 20 years, and I have a staggering yield on these bonds. And what will happen is at any particular point in time, if the market starts to adjust, where all of a sudden interest rates are higher and the people are paying more and the interest rates are going up, well, now I can say, all right, well, that's going to affect some of my bonds, but I have some bonds that I can hold on to in case the market switches back. Well, I don't have to sell everything in this particular environment. Number six on our list is our withdrawal strategies. And I'll put a link to another video where I go into great detail about a variety of withdrawal strategies that you can use. But the idea is I'm making sure that I'm withdrawing my money in a way that doesn't cause me to run out of money early, right? That's really the idea. But at the same time, and often overlooked, I need to also have a plan in place that has me comfortable and confident that I can spend the money. Because we've spent the past 10, 20, 30 years investing the money. And for some of us, making the shift to spending the money is a really big mental hurdle. And sometimes we're sitting there and we're like, well, I don't know if I can spend it because I don't want to run out of money. And we miss out on a lot of opportunities, a lot of trips, a lot of dinners with friends, a lot of remodeling, a lot of these different things, because we're just not sure how much I can spend in retirement. And so we want to go ahead and put a withdrawal strategy in place that makes sense as far as my comfort of knowing I'm not going to run out of money. I want to make sure that I'm very comfortable and confident that I can spend this amount of money without any concerns whatsoever, which actually leads very nicely into number seven, which is unexpected expenses. If you were, for example, to choose the bucket strategy, which is one of my favorite strategies, that's the idea that I have these three buckets that my money goes in. Bucket number one is going to be my 1 year expenses. So some people may do 6 months, some people may do 2 years, but a bucket number one is generally going to be on like a money market account, something that's basically keeping up with inflation. And the idea is because I have 1 to 2 years of money already set aside, if something happens with my investments, whether it's in real estate, the stock market, or in some sort of business, I don't have to take the money out of the account. I'm able to leave the money in the account for it to grow through this economic climate because I've already taken about a year of my life expenses and put it into bucket number one. That is the same bucket that you would use for your emergency expenses. If you have an unexpected emergency and you weren't ready, then that means you may have to sell your stocks in a down market. You may have to sell your real estate, even though you're getting rental income from it, because you don't have the liquidity to pay for that unexpected expense. Now, bucket number two is normally going to be something that we consider a moderate investment. That's money that we expect to touch within the next 2 to 5 years. We normally going to have investments that gives us about a 3 to 5% return. And then we're able to maintain an aggressive bucket. That's bucket number three, where we can still shoot for the moon and have about a 10% return on average. Now, because we're going to be diversifying your portfolios based off of all of your investments, not just in one particular asset class, we could say my business, or you could still invest in the stock market, but we're investing aggressively in the S&P 500 because I already have my safe assets, my moderate assets, and then my aggressive assets. Generally, if you keep them all together, then you're normally in a really good spot to be protected against some of these risks in the future. Number 8 on our list is taxation. So we often overlook taxes. I've gone into great detail talking about the way different incomes will be taxed in retirement. I'm going to link to one of those videos for you. But the thing that we have to keep in mind is if all of your money is in your 401k, which is the majority of people's retirement plan, that means it has not been taxed yet, right? It went in pre-tax. So what does that mean as far as the income in retirement? That means it's going to be taxed as normal income. So whatever your normal tax bracket is. And I'll put a chart up that shows the different tax brackets. There's only 7 of them. But the long story short is we don't want to have all of our money taxed as normal income. There are other types of income that are much more favorably taxed, and we should sprinkle that into our retirement plan. That we should not just diversify our income based on assets or risk, but we should also diversify based on taxes. Do we want tax-free income in retirement? I know I do. So maybe we look into seeing if you could get a Roth, and if you don't qualify for a Roth because you make too much, then we could look at doing Roth conversions, which is still an option, where you convert money from your traditional IRA into a Roth IRA. And now that money's tax-free in retirement. Or if you have your money invested in the stock market for a year and a day, well, that's capital gains, which is a much more favorable tax treatment. The idea of diversifying our income based on taxes is very beneficial because it can literally generate hundreds of thousands, if not millions of dollars more onto many retirement plans. Now, granted, when I make that statement, I'm talking about the retirement plans and the clients that I've worked with and looked at who were able to generate hundreds of thousands of dollars onto their retirement plan simply based on tax diversification. Now, I cannot say that for your retirement plan because I don't know where your money is at. We can also get very creative when it comes to taxation, where if you have a business, we can look at creating a retirement plan inside of your company where you offer an individual 401k or a simple IRA or a set plan. There are so many advantages that you can have by considering taxes on where you put your money. Most people, because they're not considering taxes, they don't know that their 401k is going to be taxed. They're not aware that their Social Security is also going to be taxed. They are not aware of the overall impact of taxes on their retirement income strategy. And because of that, it can lead to a significant deficit where you thought you were going to have enough money in retirement. But once you paid your taxes, you realize that there was a hole that you weren't ready for. Number 9 on our list is changes in Social Security. Social Security was never meant to replace all of our active income. Remember, for most people, we want to have about 80% of our income replaced in retirement. That normally takes into consideration cost of living and different things. The idea is if I maintain my exact lifestyle as I have today, where I don't have any less debt, then that normally means that if I'm investing about 20% of my money into my retirement plan, well, I don't actually need that. I wasn't living off of that 20% anyways, which is how we normally get to that 80% of your income. If you are someone who considers Social Security to be a significant part of their retirement income, then we have to look at a couple of things. One is, as I mentioned in the previous, we got to look at the tax structure. Is my Social Security going to be taxed? The numbers are very low as far as getting a percentage of your Social Security income taxed every single year. Also, there is numbers out there where Social Security is going to run out of money. And that number kind of fluctuates depending on the tax revenue. But the idea is that there used to be a time where Social Security, about 10 active people work to fund every one person in retirement. That number is now 2 to 1. So there's only 2 people actively working to fund every single person in retirement. Naturally, that means Social Security doesn't quite have enough revenue being generated. And there are numbers where it's 2036, 2041. The number fluctuates based on the revenue, but the idea of Social Security running out of money is something that's on the table. Now, granted, it would never run out of all of the money. It just wouldn't have enough to fund the people the way that they promise. And that's really unfortunate because it's the money that you've paid into it. But the numbers show that about 70% of what Social Security have promised to pay you is what you can expect to receive in retirement if they don't make any changes to fix Social Security today or going forward. Now, for most of us to address that Social Security shortage, it really comes into question, when should we claim Social Security? For most of you, you're able to claim it as early as 62 or as late as 70. Now, the way the numbers work out is every year that you don't claim Social Security, you receive an 8% increase on whatever that income is that you would have received. And then that would happen all the way up to 70 years old and then you maxed out. Because most of us don't have a specific plan in place to fund our retirement in those bridge years between 62 and 70, we're not able to take advantage of waiting to take our Social Security out. That is why we have to have a plan in place to be able to say, all right, I'm going to have my income generated from these revenue streams, or I'm going to get a small annuity for 8 years just to give me an income that would have been my Social Security. Maybe I'm going to have some investments or I'll work a little bit longer. You do have different options available to be able to say, all right, I'm going to be able to go from 62 to 70. Now, this is a very specific choice for each individual person. You have to consider your lifestyle, your life expectancy, family issues. All these different things come into consideration when it comes to deciding what is the optimal year for you to take your Social Security. So I can't really tell you what that year is without having a full discussion with you. But if we are able to wait until 70, the idea is if Social Security is going to cut how much it was going to pay me by 30%, well, if I have been able to generate an additional 8% return by waiting 5 extra years, 6 extra years, that's going to offset a lot of what I would have lost in my Social Security income. And our 10th and final risk to a successful retirement is your lifestyle considerations. Just what do I want to do when I have all of my time in retirement? We want to be able to put a plan together based on the goals that you have for retirement, and then we put a dollar amount of what that would cost, and then we make sure that we can fund each of those goals. For many of us, the thought is, well, I'm just going to retire and then I'm going to receive the money. But we didn't actually lay out what we want to do with our time. What does our ideal day look like in retirement? I often tell people a great place to start is by just outlining 50 goals that you would have. Who do you want to meet? Where do you want to go? What do you want to do? What do you want to experience? What do you want to learn? All of that stuff, write it all out and then just start doing them. Normally, the way that I would do it is I would put it in a list of everything I could do within 12 months, everything that maybe would take like 3 to 5 years, and everything that would take 10 years or longer. And then I would work through that list. Anything that you could do this year, let's go ahead and start doing some of those things. If it is something that we don't have the money necessarily to do it, we can be very creative. So I remember, for example, when I had first retired from corporate America to start working on my own, I wasn't generating any revenue. I didn't have enough money to maintain my certain lifestyle. I wasn't aware of all the strategies that I learned throughout that time to give to you today. But I was able to be very creative. So I remember, and maybe I'll find the picture, and if I do, I'll share it with you. But there were these local events that were put on, and it was put on by different vendors and communities. I remember one was like a local carnival almost. There was lots of rides and games, and it was a free entry. The event was funded by the vendors. The vendors wanted to be able to get with their ideal client. I actually was a vendor at this event. That was the only reason I knew about it. And I told my wife and kids, I was like, this place is amazing. You guys should come through. They're doing face painting and carnival and animal pettings. It was everything. The idea was, well, I'm going to be in front of people who were my ideal client. And because I had young kids at that particular point of my business, my ideal client was young families. And so I would go to different events where young families would go to. And sometimes as a vendor, you would pay a small fee to be in front of them, and then they could put the event on for free. Think of it like social media, like LinkedIn and Facebook and YouTube. You're able to watch these videos for free, and then they're able to sell access to their subscribers through ads with different businesses. That idea of social media where there are business people who are paying to have access to you, and these businesses are generating billions of dollars every single year, offering a free service to 99% of their audience. I'm not telling you to go to one of those timeshare events where you have to listen to something for 3 days and 5 hours with a high pressure sales environment. But what I am saying is we can be creative, that we can go on walks, we can have picnics, that we can visit family or they can visit us, that there are normally going to be events that we can go to that are relatively free or low cost. And you can still be creative and enjoy yourself while you're still working on getting the rest of your finances in order. But I don't want you to say, all right, I'm going to pause my life. I'm going to do nothing until I get my finances in order. I do think that we can be creative and resourceful so that we still enjoy our time, because that is the one thing that we can't get back. But we do need to be mindful of what we're spending our money on. Is this really worth an additional 2 months? Or is this really worth an additional 6 months or a year? And for most of us, purchasing our freedom is very important, but it doesn't mean that we shouldn't be grateful for the present, that we should not acknowledge the gift that is life and take it for granted. Assuming that one day I'll retire, then I'll be able to do all these amazing things, but we forego 10, 20, 30 years. I'm not someone who subscribes to that.